So, Atul Sodhi, Global Head of DCM at Crédit Agricole. Lovely for you to join me. Thank you so much for being here at Global Borrowers this year. Let's begin, if you don't mind, talking about what you expect to happen over the next 6 months. Now, we've had a tricky first 6 months given what's been going on in the world, but do we have any optimism to think that things will improve over the next 6 months in terms of supply and activity in the debt capital markets?
Absolutely. Toby, firstly, big thanks for having me here. Delighted to be here at this conference, and delighted also to see the number of physical attendees. It feels like we are, fingers crossed, in more normal territory. And it really is great to connect with market practitioners, clients, colleagues, face to face, and that really is a very encouraging sign. Coming to your question, that indeed is the multi-billion-dollar question in the credit markets. And to look at that for the next 6 months, I think it's important to reflect on what's happened in the last 6 months. So if we look at what's happened in the last 6 months, the world has gone through, is going through the war in Ukraine. We've seen elevated energy prices. We've seen continued increase in inflation. We've seen continued increase in interest rates. So what that has done to markets is quite substantially changed the way the markets have functioned. And for that, it'll be interesting to see what's happened in terms of various parts of the market. As an example, covered bond markets have had a fantastic year. I think they're more than 180% up year on year. And that has been the real winner in this last 6 month period. And contrast it to the other end of the market, which is the high yield market. Here we've seen significant decline in volumes. We've seen, I think, an 80% reduction year on year. So what that has meant is that this market has adapted to a more complex and a more risky world. In a more complex and risky world, we've seen high amount of issuance in low risk instruments, and we've seen limited issuance in higher risk instruments. So this is the way the market has evolved, and I think a little bit of also what's highlighting what else has happened. What else has happened is we've seen during this period declined investor appetite. We've seen higher levels of new issue premium. We've seen smaller book sizes. We've seen maturities come in a little bit. All a bit of a reaction to the market crisis and the broader economic crisis. Looking ahead, I remain cautiously optimistic. I still think that we will have a significant amount of funding issuances from the banks in the form of covered and senior instruments. But I also believe that if we see some resolution of the Russia-Ukraine situation, some stability in the outlook of the markets towards rates, we will see potentially in the period September to November of this year relatively strong volumes. So far we've seen, as I mentioned earlier, limited issuance of high beta instruments. I feel that both corporates who might need corporate hybrids and banks that need capital instruments, be it 81, Tier 2, they will access markets given that markets could be more functional, more stabilized in that period. So I remain cautiously optimistic. I think at the end of the year, it'll be a decent year for credit markets. It'll be a decent year for issuers to have accessed markets for instruments which were pretty wide open and accepted by investors. So I remain cautiously optimistic overall.
Thanks, Atul. You mentioned on a panel earlier on that ESG issuance was down as well, which perhaps on one level is a little bit surprising given how much money we need to invest in renewable energy, for example, given the Russian problem at the moment. What can we expect next from ESG issuance in terms of not just supply, but I guess also innovation too?
Yeah. So I think to cut the long story short, I believe the ESG market has very strong fundamentals and it's here to stay simply because there's no planet B. We have to climate change has to be addressed, and the financial system is going to be a part of the solution of that situation. Having said that, this market is also one which is going through a bit of a let's say rethink and a recalibration. By that, what I mean is that on the regulation side, this has in the past remained a largely unregulated market from the context of regulatory bodies. It has been, of course, self-regulated by ICMA and market participants, but the EU and other regulatory bodies have not been as active as they are now, and they are professing to be in the future. So this is a market that is in some sense waiting for the new regulations to fall in place and to then come back in a more fundamental and a fundamentally strong manner. The other topic that is happening is, as you've seen, there has been some press about some investigation on some asset managers on the way they've treated green and non-green instruments, and the much talked about greenwashing. That has, to some extent, given market participants the chance to step back and be a bit more more deliberate about how they go ahead. And again, this is going to, in the long run, come back with a market which will have far stronger fundamentals, with issuers knowing relatively well how to comply with regulation, investors knowing how to classify their investments quite clearly so that there is no acquisition of misallocation or mislabeling. And the regulators will have a relatively clear path on how they want sustainable finance markets to evolve. So I would almost say that this current period of 6 months, where we've seen a slight decrease in volume year on year, is not a reflection of how this will evolve in the future. I think we will have a market which will be strong, very fundamentally robust, and will be one which will support the growth of the economies in the right manner.
So you don't think there's a danger then that ESG as a topic, as a concern, will be deprioritized given the problems, the issues, the concerns that we have facing us right now, i.e. cost of living, inflation, war in Europe, supply chains broken, that kind of thing?
Absolutely not. I don't think ESG can be deprioritized simply because it's too big a topic and we just don't have time to deprioritize it. In fact, when we look at the behavior of markets and when we talk to investors, in the past, investors were looking at issuers through the filter of credit quality and price versus credit equations. Today, they look at issuers through the filter of the previous filter, but also very strong ESG filter. And this ESG filter is actually driving a lot more investor decisions today than ever before. And I think this is something which is never going to go back in reverse. And issuers that have been slow to move down the path of sustainability are realizing that if they do not have a clear sustainability story to the market, a clear transition story to the market, they run the risk that their access to credit markets could be diminished in the future.
Atul, thank you very much.
Thanks, Toby. Thanks for having me here.